All right. Hey, everybody. We are here with episode number 11 on the MAREI podcast. I'm here, as always, with James Gregg. We're part of Boulder Creek Investments, and we're here today with Kevin Roller and Alice Lund of Leader One Financial. And they're here today to tell us about their services and what they're dealing with in the market. So that's going to be interesting. Appreciate you guys joining today.
Yeah, absolutely. Thanks for having us.
Yeah, so go ahead and give everybody, one of you guys can start, doesn't matter, introduction and, what role you play with the company, and tell us a little bit more about the services, and we can roll into some specific questions.
Yeah,
I can go first, I guess. Yeah. So I joined Kevin's team last fall. I was originally a loan officer back in the early 2000s all the way through 2009, and I left the industry for about 10 years and ran a home improvement company. Always knew I wanted to get back into lending and had known Kevin from back in the day. And so I was really excited to join his team. I'm a licensed loan officer, but my role is more on business development and just taking care of relationships. I go to all the MAREI meetings, and that's been a great experience. So.
Awesome.
Yeah, have a good day, bud. I'm technically the Senior Vice President of Production for Leader One Financial. I happen to be one of the owners of the company as well. I'm also a producer, and I'm also a real estate investor. So I wear a lot of different hats. Mainly, we'll talk about lending today, but I also own 39 different properties. I own a couple apartment buildings, some multifamilies, obviously, some fourplexes, and a lot of single families as well. And then on the origination side, I'm one of the top originators in the United States of America. I'm in the top 1%. So we do a lot of business for investors and primary residences as well, second homes and all that. So.
Okay. Interesting.
Busy.
Yeah. I mean,
really busy.
they have different perspectives for sure. The $1 million question is, so just for a market update, tell us what changes you've seen come, the past month or so as far as the lending field goes.
So there's been a lot of changes, a lot. So we've seen, and I don't know I haven't watched your other 10 episodes, so I apologize. I don't know if you guys have talked about the market fluctuations, the mortgage-backed securities, Fannie and Freddie's reactions, the forbearances.
Mm-hmm.
Have you guys spoken about all that?
Not so much. I mean, we get different perspectives from, multiple different service providers. So it'd be interesting to see, specifically what you guys have seen. So yeah,
Okay.
You can go ahead and go over what you're seeing right now. That's totally
so we'll talk about just, let me look at a calendar here to help me get my bearings. So yeah, back on March the 6th, right, we saw the bond market at an all-time high. And then with that, we saw rates drop as low as they'd ever been. For a day, they were even below 3%, right? And then the Fed came out and cut rates, which you would think would bring rates lower, but they ended up coming in higher that Monday and Tuesday. Throughout that week, it continued to be volatile. The Fed came out on that Friday and said they were going to cut the rates down to nearly zero overnight. From Thursday to Friday, nobody knew it was going to go on. The rates continued to go up during that. So we saw rates in the fives for a short period of time, right? So the rates have been all over the place. You saw lenders tighten up, not because of the rate volatility, but because on the back end you had liquidity issues. So as if you hedge your fund, right? If you're hedging it and the rates, and you've locked in at, let's say, 3.5%, and the 30-year goes to 3%, then there's what's called a margin call. You've got to pay cash, right? So that's one issue of a liquidity issue. Second, they have warehouse lines that were just hitting a bulge, right? They had so many people looking to refinance, banks, lending institutions all across the nation. So they had a bulge there with liquidity issues or capacity issues, right? And then you just had the crazy marketplace that was going on. And so you saw a tightening up on the non-QM products, right? Non-quality mortgages, hard money loans, all that started just kind of tightening up. Then the government came out and said everybody could have forbearances, right? So that added to it as well. So the forbearance issue was, so if you're a Ginnie Mae seller servicer, and Ginnie Mae's anything government, FHA, USDA, VA, not necessarily investment properties, but anything government related, you still have to make those payments as a servicer to Ginnie Mae. So then you saw people kind of take away, like, hey, we're not doing government lending, we're not doing FHA, we're not doing VA, we're not doing USDA, or they were charging like astronomical points, like we'll do it for 14 points, or we'll do it at 6% when the actual rate should be 3.25%, right? So you saw that happening. So there was all this going on the back end with different lenders. I had other mortgage companies calling me up saying, hey, our CEO came out and said that we're not originating any more loans, but that we could give it to other lenders. And I thought of you, could you take over these loans for a group of people in Nashville, Tennessee? I had somebody else here locally call me up and say, hey, all of a sudden overnight, they said we couldn't do VA loans below a 680 FICO. Can you help us out? And I said, yeah, absolutely. We can, because we didn't add any of those additional overlays as a lender. So all that was going on, right? Well, that day that the rates went up, it always takes the investment rates a little while to come back down. So the conforming rate came back down. They're back down in the low 3s right now, right? But that investment rate stayed up for a while into the 5s and high 4s. It's just now recently started to creep back down to where you could get, like I did, quoted a couple of refinances yesterday in the high 3s paying 1 point. Unbelievable rates, right? For an investment property right now. Yeah, unbelievable. So, so we've been dealing kind of with that over the last 45 days, if you will. Or I guess that would be 2 months, 60 days. Yeah.
Yeah, it definitely seems like it's pretty volatile out there for sure. Do you?
It is, and that's been like day-to-day volatility. So it's like, you know, you really, what has been interesting is that we've really tried to keep an eye on the market, even just, you know, morning versus afternoon, and trying to pick those good days where the rates kind of dip back down to lock people in. There's been a lot of watching the rates on a day-to-day basis.
It's pretty fluid. Do you see, do you forecast any changes coming up here in the near term or longer term? What changes do you see?
So here's the main thing here's what I see. So first of all, rates are as low as they've ever been. And they may actually go a little bit lower. So the government is looking at opening up the 2% coupon. It's been open since November. I should say they're looking at filling that coupon. If that happens, you may see the rates dip below 3%. So there's that. But looking further into the future, you're probably they're going to come out Thursday, I think, and decide they're most likely going to put another $3 trillion into the stimulus package, right? All that money entering into the economy at some point is going to catch up, and we'll probably see inflation, right? Right now, there is no inflation. It's negative because the oil price dropped so low, right? So actually, I don't even think the index you can actually look at it correctly right now because of that oil. And it may never come back, right? That's always been an indicator. But going forward, all that money hits the economy. You might see inflation start to creep up. If you do, the only way for the Federal Reserve to offset it is by increasing the interest rates, which are 0, right? So you could easily increase the interest rates, right? So if that were to happen, then your buying power drops. So let's just a quick, real easy example. I buy a $200,000 home at 4%, just for easy math. Simple interest is $8,000 on that, right? I buy it at 6%. Simple interest on that is $12,000. So the delta is $4,000. Call it $350 a month for easy math. So what I'm telling people right now is buy right now, because if you're waiting for a value buy, it's probably not likely going to happen. In fact, what will happen is, let's say prices drop 10%, because they're not likely to drop 20 or 30%. Don't get me wrong. There may be a couple of value buys that happen out there, but as an industry as a whole, we have not enough supply on the residential side, right? Not necessarily on the commercial side, but on the residential side, there's not enough supply. There's 1.4 months on the last report. A balanced market is 6 months. So if people do come out of those forbearances and there are foreclosures and houses hit the market, that's actually good for us to balance out our market. You could still see, in fact, they're forecasting appreciation at 1% during this time. So still prices will go up, but let's say they didn't. Let's say they dropped by 10%. A $200,000 home decreases by 10%, that's $20,000. That's about $10 a month that you could save by waiting to buy because you think the market's going to dip. as opposed to buying now, and maybe it does dip 10%. Maybe you could have saved 20 grand, but that interest rate right now is saving you $350 a month. And if you're an investor, it's all about the numbers. It's the math. Like that makes way more sense than trying to get it 10% under the value. Does that make sense? So what I would say going forward is we will have a shift in the market, but it'll probably be because the rates go up, which will affect your purchasing power. Right now is the best time to buy.
Yeah, that's I mean, it's always a gamble, if people wait. Everyone's weighing prices to interest rates, and obviously the next quarters are going to be pretty bad out. So I think people are kind of in a conundrum. When that economic data comes out, what's gonna be the reaction in the market and the real estate market. But like what we're seeing now, I mean, James and I are on the commercial side, and then also we do agent stuff too on the single family side, and it's not like we've seen along with everybody else prices come crash down. And I mean, there's just a handful of people that I talked to yesterday. They're still getting $5,000 to $7,000 over asking on houses, in the Shawnee area. So, yep. I mean,
that's what we've heard from our agents too. I mean, multiple offers on almost every listing.
Yeah, exactly. So it's definitely tough to tell. But I think, people had funds saved up. They're just not scared. Everyone's, still understands, they obviously real estate investing become a huge thing and last so many years. I think we have a lot of money on the sideline still. So even if we did have pullback, I think you're going to get a lot of fill in also from investors waiting on the side.
I'm curious also, Kevin, kind of going back to what you're talking about before with the market volatility and everything, would you anticipate further volatility in the market? Or are you just seeing kind of this general macro trend of maybe down and then back up? Or are you thinking that it's going to be kind of crazy for the next 3, 6, 9 months?
The reality is I don't think any of us can forecast what's going to happen in 2021 because the repercussions of shutting the economy down for 30 days, 60 days. And now California, I read an article today, they're saying maybe.
I heard it was somewhere I swear it was like Oregon shutting down till like July something.
Los Angeles County officials are expected to extend the stay-at-home order for another 3 months. Came out today. So
is that shutting down all the businesses for 3 months?
It's a stay-at-home order. I'm not sure.
Oh.
Yeah. So
yeah, that'd be disaster.
Yeah, and a lot of their universities, I read an article, they're not going back for in-person classes
semester.
in the fall.
Yeah. Yeah, they said that as well. So it's hard to say what we're now. The people that are in the market right now, though, are serious buyers. Like you're not trying. If you're looking at a house, you're a serious buyer. So it's weeded out a lot of the licky-loos, people who are wanting to kick the tires, and then something else. Since the hard money has dried up a little bit, the investment opportunities have actually picked up potentially a little bit because that's knocked out a segment of buyers right now, right? So if you can go conventional, if you can put 20% down and buy a fourplex, you're going to have less competition right now with rates being low than you did 3 months ago because of the hard money. Does that make sense? It's a great time to buy. It really is.
I mean, do you think it'll last for months or, I mean, towards the end of year, just in case someone's not exactly ready to buy now? I mean, it's tough to say too, but I mean.
So we're seeing more purchase applications month over month this year, and it's up from last year right now as well. So we're not seeing that scale back really in our office. So, and most of the realtors we're talking to, some of them have just completely stopped working, but the ones that are still out there and grinding, their business has picked up.
Right. And obviously after the quarantine, people are going out more to view.
Yeah.
Mm-hmm.
Yeah, we'll start seeing, probably to that point, we'll probably start seeing a lot of houses hit the market, right? People are going to be like, okay, now I can put my house on the market, right?
Sure.
You had some realtors saying, I won't put a house on the market until the 15th of May, right? In Jackson County. So.
Mm-hmm.
Yeah. Now, what about terms for some of the loans that you guys are seeing, Alice and Kevin? Obviously, this being the MAREI podcast, we have a lot of real estate investors listening, so they're not your I've got one mortgage person. Maybe they've got 3, 4 mortgages. They're looking at a refinance, a cash out refinance. On the commercial side of things, John and I have seen the terms shift dramatically, much lower LTVs. They're looking for interest and all sorts of reserves and those types of things. Are you seeing those shifts on the residential side as well, or is it kind of the same, but just with the interest rate moving around?
It's really the same. Yeah. So we're still doing, I take that back. Yesterday, 2 mortgage insurance companies came out and said they're not going to insure that the 15% down loans. 2 mortgage companies came out of 5 major ones. But most people put 20% down. It doesn't always make sense to put 15% down. As you know, if you've ever tried to put 15% down, you're usually paying a point or 2 on the rate. Then you're paying mortgage insurance. And when you do the math, you're better off just putting 20% down.
Mm-hmm.
So, but that's the only thing I've really seen. The rates have actually, I quoted, somebody was looking at purchasing a duplex yesterday for $375,000. It was a full duplex. And with paying a point, I feel like it was like 3.25. Like it was stupid low on a duplex, right? I mean, the rates are really good for the investment properties if you've got a good loan to value, right? And you've got a good credit score. And then on a refinance, they were looking at like 3.875 at 70% loan to value to pull cash out on a 30-year fixed term. 3.70, 3 point on cash out. So they already own it. They're just cashing out their equity. Those terms are unbelievable.
Yeah, that's great.
Yeah.
Yeah. So that was lead into my other question. You recommend, obviously, I know banks are kind of put cash out refis on hold for investment properties. I know they're doing it for personal homes. And what about HELOCs? Do you think people should be possibly looking at taking equity out in case of instability in the future? Or?
So two things. We have not stopped doing cash out at Leader One. We're still allowing people to cash out their investment property and their primary residence. I would say that we are not through the woods yet, right? I mean,
right.
We're going to see like the stock market's down, 500 points maybe right now?
Is it?
Today. So here, I'll tell you. I'll just look at it real time. Yeah, 500. We're down 504. No, 679 now. So it's dipped a little bit more. We're down 679 points today. That's just today because a little bad information came out. But what happens 6 months from now? When again, there's a couple schools of thought there, right? First of all, there's obviously people that are buying in the market right now saying, hey, you know what? We're betting on the come. We're betting that everything's going to be fine 6 months from now, right? That's what's keeping the stock market up right now. People are saying, hey, you know what? Starbucks dropped an all-time low. I'm going to buy Starbucks. I'm going to buy Amazon. I'm going to buy Apple, right? People are investing right now. But there's also the fact that we don't know what's going to happen 6 months from now. As people come out of forbearances, people can't make that payment. We have foreclosures. People are living on their reserves right now, and all of a sudden they can't make their house payment. Their company doesn't open back up. When that stuff starts to hit, you might see the market drop. So when you say, should you take cash out? I think of it in a different aspect. Yeah, absolutely. So that you can invest it. There's going to be a good opportunity, I think, in the future to invest money in the market. So I think it's a good idea to have a home equity line of credit to buy the right property or invest it in the market.
That makes sense. Yeah, I mean, it's the equity is there until it's not. For your home, if you're looking to put it towards an investment property or the market. obviously there's a lot of people like trying to catch falling knives too. I think I saw a stat that on Robinhood, they had millions of people open up accounts and 50% of them were new, hoping to become, traders and become millionaires over the next couple of weeks. But surely that's probably not going to happen.
No, probably not. But here's a fun thing. It's impossible to have a bubble when you don't have any supply. So people are like, oh my goodness, are the house prices going to drop? Are we in a bubble? We haven't been in one. We're not in one. It's impossible to be in one right now. We don't have enough houses to be in a bubble.
And the cash out options aren't, we're not going, it's not like the 08, 09 where we're doing 125% loan to value loans or anything like that. You get a HELOC. I don't know of many banks that would go even above 80%.
What's the percentage on investment property cash outs again, refis?
75%. Yeah.
The LTV
75% we can cash out. Sorry, go ahead, Kevin.
Sorry, the LTV or the interest rate?
Both, I guess.
Yeah, so you could cash out between 70 and 75 depending on your score and the type of property. And the rates you can, with paying a point, you can be in the threes right now. So
okay. And you have been doing cash out the whole time, not just like last week?
Yeah.
Interesting. Okay.
So we're getting short on time, so want to be respectful of your time as well as not make this ridiculously long for the viewers and listeners. So we'll start to kind of wrap it up here, but as we get there, I'm curious, again, going back to the average Joe real estate investor, what can he or she do to, I guess, best equip themselves for financing their next investment property, either now or 6, 9, 12 months down the road, just in general?
So I would advise that if you've got equity to pull it out. So if you bought a property you bought 3 years ago, it's appreciated, you paid it down just by making your payments, cash that out up to 70% loan to value. If you've got equity, take that cash out and then be prepared to buy another property now. Like be on the lookout for that next investment. So use the money you already have made. And then if you don't have any equity, but you're looking to buy a property because you've got some cash sitting in a 401k, now would probably be a good time to honestly take a loan against your 401k and look to purchase another property. We're kind of at the high at 23,000 right now, right? It could potentially go down. It's not likely to go through the roof right now. So this would be a good time to potentially take a loan against your 401k and purchase your first investment property.
Okay.
That sounds good. Go ahead and give people some information on how to contact you guys, maybe website, Facebook info, stuff like that.
Alex?
Well, our website, I guess, youroneHome.com is our link to apply.
The you number
can find
one.
us on, and the number one, then the number one home.com. We're on Facebook as the Roller Team, Leader One Financial Roller Team. You can call me on my cell phone. It's 913-488-1769. Our email addresses are just our first and last names, and then leader and the number one.com. And Kevin, what's your cell phone?
816-805-3420.
Uh-oh.
Yeah.
Okay. Prepare for calls. I don't think this group will be making any frivolous calls. I think it should be all business. So I know everybody's asking about lenders. There a lot of people who refi or stuck right now. So it's good to hear that you guys are still moving and that there's options out there. So that's good to hear for sure. Appreciate it all. Oh yeah, just to wrap around real quick too. Kim always wants me to mention for the MAREI group, if there's any partners that want to become part of the MAREI sponsorship, it's $4.99 a year and $135 a quarter, and everything's put in their print, newsletter, Facebook website. You go to marei.org/membership for details on that. Other than that, we appreciate you guys for joining. Thanks.
Yeah, thanks for having us.
I think everyone is getting over the lockdown, so it's going to be tougher to get people to do these web interviews, I feel, because everyone wants to go outside. But actually, this is a good week to do a couple because it's cold and rainy outside, so I might as well do a video.
Sounds good.
All right. Appreciate it, guys.
Have a good week, guys.
Thanks
Thanks
guys.
a lot.
Have a good day.
James. Bye.